All right, welcome back. So we got the pre-open 2 minutes away, but Anuj is here for a quick trade setup and how he's seeing things. Anuj, hi, what are you watching?
Hi, Prashant. So it looks like now Sonia has taken over that responsibility of green, right? Trying to help the bulls. But look, I mean, the market needs some divine intervention. It's an oversold territory. The market is in extremely oversold territory. The problem is market can remain overbought and oversold for long. But the put-call ratio is at a zone from where normally, anecdotally, you see markets bounce back, 0.71. FI stats also in oversold territory. So let's see, the first rally normally is vulnerable to be sold into because of the big red bar that you had seen. I think it's the second rally which becomes very important. The selling in IT yesterday is just a reminder of the point I've been also making that, the IT index is still not out of the woods. And this was quite brutal, the way IT stocks sold off. On the Nifty, we are now at 200-day moving average. This is the third test of 200-day moving average. The first two tests were defended. Anecdotally, if the third test fails, then the market makes a lower low. And in that case, 16,818 becomes important because that was the last lower low that we had on closing basis for the Nifty. And if you break that, then the door opens towards 16,450. However, on the upside, for the strength to come back, you need to close above 17,350 to negate that lower high. I think the Bank Nifty is crucial to watch out for because even yesterday it outperformed. The decline was less than the Nifty, but it's showing some signs of fatigue, almost as if, like the Sachin Tendulkar of 90s, just can't keep performing on its own. And on the data side, there's no major put build up till 38,000. So I think 38,500 to 38,000 becomes a crucial level to defend. And on the upside, 39,500 to 39,000, which is where you have the call build up as well, is something to watch out for. Keep an eye on ICICI Bank and SBI. If these stocks start to recover, then perhaps the market rallies. Otherwise, there could be some problem. As I said, the first rally would be vulnerable to be sold into.
Okay, I'm trying my best to bring some green on the screen, Anuj, but looks unlikely, at least as of now. Thanks a lot for giving us your thoughts. The first tick on the Nifty is it started off just a tad bit in the red. We'll wait for these rates to settle. As of now, just hovering around the 17,000 mark. But what stands out is the weakness in Asia. So Hong Kong right now is down over 300 points. And as we've been discussing, there is a new COVID variant emerging in China. China has detected a new Omicron subvariant. Now, it's not so much about the virus as much as it is about the stopping of manufacturing as well as the impact on consumption. And that has sort of a snowball effect across the globe. And that's something that we're going to keep our eye out on very closely. But Devin Choksi is still with us, so let's get some calls out of the way. By the way, today we have big numbers. There's HCL Tech that comes out in the evening at 5. There's Wipro as well. Devin, either of these names that you like for the longer term and anything that you would expect, especially after what you saw with TCS's earnings?
So, Sonia, I think the relative stability is high as far as I think TCS and Infosys is approaching the business is concerned. Particularly for Wipro, I think the acquisition-led model, I think, is basically going to give some kind of a growth momentum to this company. But the bigger challenge would be on sustenance side. And unless I think few quarters passes by, I think you would not know whether I think the acquired companies and I think their integration is successful in the business. So till such point of time, I think the uncertainty factor would continue as far as I think the Wipro is concerned. That's what my reading is. And probably I think that is one of the reasons for which I think I would still prefer to go with I think the likes of Infosys and TCS, where the prices have corrected, valuations have become attractive. And at the same time, I think the growth promises to be around 15-16% in the range. So obviously, I think that is, I think, giving me more amount of comfort vis-a-vis the likes of Wipro as far as I think the selection of idea in the portfolio is concerned.
All right. Thanks a lot for that, Devin, joining in and giving us your cues on individual stocks as well. But let's talk about one of the other companies on our radar. Genesis International received a land titling order worth nearly 46 crore coming in from Andhra Pradesh. The company has also recently announced a deal with Bentley Systems to provide 3D mapping capabilities for major cities across India. So to discuss this and more, we have Sajid Malik, who's the chairman and managing director of the company, joining in. Thanks a lot, Sajid, for joining in. First up, if you could tell us, what does this 46 crore order book order take your order book to, and the potential of revenue coming in from Bentley? Comment on these two things.
Good morning. Yeah, the land titling project is important because it heralds the new approach that perhaps will happen in India thanks to the liberalized geospatial policy, wherein we are able to solve this acute pain point of a bottleneck which is causing not just court disputes but also land acquisition for many infrastructure projects. So with the constellation of sensors that we have launched, this is the first such project where we'll be using a very, it's actually the world's largest SWAT sensor, which we'll be using to capture almost 30,000 square kilometers of land in Andhra Pradesh. We believe this will, perhaps the successful completion of this will lead to several other such projects across many states.
Anything more in the pipeline?
We are talking to several states. We have begun this project now, and I'm sure we'll see some traction moving ahead.
So any visibility on what this could do to your earnings? Your FY22 revenues were almost at 120 crores, which is a growth of 50%. On an average, what could you do by the end of this year and next?
We are not giving any guidance so far. Our traction is pretty good. We are in the process of building out, as we said earlier, our digital twin content program. This is significant in terms of the content that we are developing for the entire geospatial community within India. So our current year is going to be largely focused on building out the content and on initiating some of these projects, such as the land titling projects.
What does your current order book stand at after this order? Because the last known number that we have is a little over 100 odd crores. What does it stand at now?
We have a reasonable order book right now.
Could you quantify that?
It's in excess of 200 crores.
And by when does the entire book get executed? And what kind of order inflows can one expect in the second half of this year? If you could give us numbers.
We are not giving any guidance right now. This project has got to be finished by in this particular fiscal year itself. So we will be completing this order in this current financial year.
Okay, just all right. Just a word on why the promoter holding has been declining. I mean, in June it was almost 48%. It's come down to 40.6% now.
We had a fundraise recently where we raised around 250 crores in equity. We have some market investors who invested in the company, Malabar and Foreign Tree, Matthew Syriac, etc. So because of the fundraise that we did, we had a dilution.
All right, Mr. Malik, thanks very much for that. I appreciate you joining in and running us through that order when we are, just about 9 minutes away from the market opening. The pre-open rates are sort of jumping all around, and we should have them up. 34 points, very tentative start, just a 0.25% higher, neither here nor there. So this is what we have right now. Lots of stocks to discuss, but it's almost 9:10. Let's get some more trading ideas out of the way. Sudarshan and Mitesh are back. Sudarshan, your trades?
Well, for the Nifty and Bank Nifty, it's an avoid day for me. And Bata India is a buy with a stop under 1770, 1770.
And Mitesh, what about you?
Yeah. I would choose a sell, and there will be a sell on Havells with a stop at about 1301 for targets of 1250.
Right. One of the stocks which has settled higher in pre-open is Delta Corp. The results were very strong. We did see record revenue coming in for the company year on year. The EBITDA as well has turned positive as against a loss the same time last year. But of course, that came on a low base. The stock ended lower yesterday. So where does it go and how does it look on the charts? Mitesh, Delta Corp?
In fact, I've been liking the stock. The overall pattern has turned positive in the last few weeks. And while yesterday with the market, it did decline and it's yet not managed to get past the 200 average, which is around 235, 237. I think there is a chance of that happening. And once that is cleared, 255, 256 is what I'm looking at for the stock to hit. So I think, the idea should be now to look at support levels to buy into this one. Closer to about 210 would be a medium-term support area. Buy there with a stop below 200 for targets of around 255.
Just to take some names which moved big time yesterday, Sudarshan, I don't know if you've looked at India Cements collapsed 12%. sorry, Mitesh is with us. Mitesh, to you, India Cements was down 12, Divi's was down 5, Mazgaon Dock sold off on huge volumes, 8% after a up and up kind of a rally. United Spirits was down 6%. Anything on your radar for anything in terms of follow through?
Yeah. So in fact, we had a sell on DVs yesterday. I think that still has got more downside left, and there was a very negative candlestick pattern on the stock chart. And I think, the recent swing lows for the stock were closer to about levels of 3450, 3440. And I think it will break that and head towards 3300. So very negative over there. India Cement, along with some other cement stocks, has had a negative candle, but it's still, the structure isn't very weak. But the stock can definitely give a pullback to the medium-term averages. So around 225, 220 is where I expect the stock to find support.
To watch actually is Gujarat Pipavav. The volumes looked really good this time. Container volumes went up almost 18.5%. This stock has not done much this year, to be honest. It's down almost about 12% this year. So let's see how that one goes. And the other one that's really topping charts is Liberty Shoes. Of course, it's had a dream run this year. It's up almost 148% this year, but looking pretty good this morning as well. Nmdc has moved towards listing of its steel business. So that's another thing to keep on your radar. Sonal is here to give us the details. Sonal, over to you.
Good morning, Sonia. Well, yes, the stock will be in focus because the company has received approval from Ministry of Corporate Affairs, and that is to demerge NMDC's steel plant, and that is something that the street was watching out for. And in next 2 months, NMDC should see the listing of this steel plant entity. So that will be the big event as well. Now, how are we valuing the steel business of NMDC? That will be listed separately. So company has a capex of approximately 19,000 crore rupees on the steel plant. So if we go by the capital work in progress, so that is what the market is valuing it at. So at 40%, it will be around 26 rupees per share. At 50%, it will be around 32 rupees per share. And if capital work in progress is at 75% of that 19,000 crore rupees, it will be listed at 49 rupees per share. So these are some levels in terms of listing that we should be watching out for. And the stock, of course, will be in focus on back of this.
All right, the other stock on our radar today will be Infosys as well. Rima, the resignation that has come in just 2 days ahead of numbers, how should the street look at it?
Well, the street is surprised. So the news is that Infosys president Ravi Kumar S has resigned effective yesterday, which basically means no notice period, and the resignation comes just 2 days prior to the board meeting, which is scheduled tomorrow, where they will be considering earnings along with a buyback. So always there is going to be a key man risk, right? Because he was one of the important people, perhaps second or third in terms of the power ranking or in terms of, responsibilities, etc. But a company like Infosys is a well-oiled machine. So usually one exit, especially someone who's been with the company for 20 years, is unlikely to, really shake things up or result in significant business disruption. But there is always a key man risk, which is why we will be watching Infosys today.
How about HCL Tech comes out with numbers later in the evening? What to expect there?
So let me quickly run you through the expectations. Dollar revenue growth 1.5% quarter on quarter. Constant currency revenue growth should be between 2.5% to 3%, which means similar to the growth rate that it clocked last quarter. EBIT margins are seen expanding by 40 basis points to 17.4%. The reason we're not seeing a significant margin expansion this quarter is because of the wage hikes. The HCL Tech's wage hikes to its employees is effective 1st of July. Profit, according to our poll, should also show a muted jump of just about 4%. The key to track is going to be, does the company hold on to its FY23 guidance? Well, on the top line, the management has been very confident, and even the street is confident that HCL Tech will be able to deliver a 12 to 14% revenue growth. The question is on the margins. In April, the company said that FY23 margin guidance is 18 to 20%. In July, post Q1 numbers, the company said margins will be at the lower end of its guided band, which means closer to 18%. But the street is still not convinced. There are many estimates like Kotak and Ambit who have penciled in HCL Tech's FY23 margins below 18%. So is the management confident about meeting at least the lower end of its guided band? That's something that the street will be tracking very closely when it comes to HCL Tech.
Right, Rima, but we can't let you go just yet. Wipro is also reporting numbers. What should the street expect from that one?
Dollar revenue growth 2.4%, constant currency revenue growth of 4.2%, which is within the company's guided band of 3 to 5%. So no surprises, at least when it comes to revenues, and top line will be driven by some of the acquisitions that the company concluded. Again, in the case of Wipro as well, the margin expansion is fairly muted, just 15 basis points, and that's because Wipro doled out compensation and hikes to its employees effective 1st September. So there is that 1 month impact of wage hikes, which is why margin expansion, despite rupee benefit, increase in utilization, is fairly limited. Now again, even in the case of Wipro, the street is going to be watching out margin improvement from here on. They were confident last quarter that margins have bottomed out in Q1. But how much can it rise from here on? The company's medium-term margin guidance is 17 to 17.5%. How soon can they get to that? And secondly, Wipro also gives you a quarterly guidance. So next quarter's guidance will be very crucial. It's difficult to gauge, get a consensus this time because of how volatile the macro is. You've got Kotak on one hand penciling in 0 to 2%. You've got CLSA at 2 to 4%. So I think something in the middle should be, what the street is anticipating. And finally, acquisition that they did, Capco, has a great presence in Europe, and it also has a lot of consulting revenues, which typically get cut when things go tight. It's discretionary spending. So performance of Capco and outlook of Capco will be crucial. Back to you.
Okay, thanks a lot for that. Markets are heading into the opening for the day. Just 15 seconds left. The Sensex and the Nifty are actually indicating a start in the green, led by Infosys, Britannia, Eicher Motors, HCL Tech. So let's see how it shapes up. The volatility actually kicks in the second half of trade, so we'll be looking out for that as well. That's the first tick for you. It's quiet actually, but with a bit of a green hue. So the Nifty is up about 35 odd points. The mid caps are up about 110 points. The Bank Nifty is flitting between the red and the green line. So do keep that on your radar. HCL Tech ahead of its numbers is actually up about 2 odd %. Infosys is moving on from the president of Infosys resignation. Not too much concern over there. Wipro, TCS. In fact, all IT stocks are in the green right now, followed by Adani Group stocks, Adani Ports. You have Asian Paints. There is Nestle India, IndusInd Bank, Bajaj Finserv, NTPC that are topping the charts this morning on the green side. On the downside, as I said, the Bank Nifty is a bit of a drag. Nothing alarming. It's just down about 20 odd points at the start. ICICI Bank is the one that is dragging its feet a tad bit. ONGC, Reliance, L&T, Maruti Suzuki and Bajaj Finserv are a couple of other stocks that are in the red. There's no great directional move in the market, but let's not forget that yesterday we saw a deep sell-off in late trade. So perhaps that could kick in today as well. But for now, the start for the Nifty is quiet, very, very quiet start to trade right.
Okay, it is very quiet in terms of start, absolutely 15 points, so not very much going on at all. You got Delta Corp, which is up about 1/3 of a percent. We were talking about that with regards to numbers which are strong. So that is indeed starting higher. Let me just highlight a bunch of other names which are moving around. Liberty Shoes, I think Sonia mentioned, is up 8.5 odd %. It's coming up with strong volumes. There is Kalyan Jewelry, which is up 1%. We had the management with us earlier. Markson's Pharma is coming up with an 8.5% move. Again, I mean, volumes are low, but for this time of the day, it's coming up as the top traded names. JMC Projects is up 3.5. JP Associates is starting higher. But again, volumes are nothing to write home about. We're beginning with a 2:1 advances to decline ratio. So that is good, broader markets. India Cements sold off some 7-8%. It's down another 2% today. On volumes, there is Mazgaon Dock, which was down 7%. It's down another 1%. So in some of these things, there is some follow-through which happens. Z is down almost 1% now, 270 on Z. And you got Hindalco, which is down about 1 odd % as well. AU Bank, maybe you can throw in there, which is down 1%. Biocon is down nearly 2% now. So these are initial starting rates. I mean, for the Nifty, it's neither here nor there. Flat at basically at about the 17,000 mark, almost unchanged from yesterday. Mangalam, anything else?
A bunch of stocks. You spoke about Markson's Pharma. Yesterday in dying hours of trade, we got the news that they've entered into a business transfer agreement with Teva Farm to acquire the business related to manufacture and supply of bulk pharmaceutical formulations. That's one of them. The other bunch of stocks I'm watching out for, Suzlon is doing well this morning, up around 3.5 odd %. You spoke about Liberty Shoes up 30%. I'm also looking at Berger along with Asian Paints, and that's primarily because of lower crude prices. And Container Corp, that's the one which is up around 1.5% in today's trading session. Maybe the street is pinning some hopes coming by on their second quarter volume update, because before results, these companies do give their quarterly volume updates as well. So that's about a bunch of stocks that we have.
Move on the index, Mangalam. So, we were up 15, we're up 42 now. So as let's just look at where this is coming from on the index. HCL Tech is the big one, which is up 2%. Tech was disappointing, absolutely disappointing move. Maybe it was positioning because the IT index had done 3% the week before. People sold into that.
Actually,
but Tech Mahindra is another one which is up 0.75%. TCS, which sold off 2%, is up. It's starting a little higher. Wipro. So IT once again is looking better as compared to most other areas in the market.
Yes, IT is doing well, but I think the last bit of an up move that came on the index perhaps could be on account of Reliance, which has moved to the high point of trade, and that is the weightiest stock that we have. So Reliance moving higher would take the index higher. So it opened in the red, and thereafter it has moved into the
also,
green.
Quick word on Marksans Pharma, right? It's up almost 7% right now. The company will acquire or is looking to acquire Teva's India manufacturing facility in Goa. The amount is not disclosed, but Marksans has said that will help them, sort of strengthen their core growth, and I guess the street is focusing on that.
Marksans is today's Panesia, right? Panesia was up 20. But same pharma space. We'll come back with more stocks. It's not holding. Gains are being given back on the index level. Andrew Holland is with us. He's Market Master of the Day, Chief Executive Officer at Avendus Alternate Strategies. Andrew, great to have you with us here back on the show. Thank you very much.
Morning.
More downside or a little bit of a turn here in global markets and markets here? What's your sense?
My sense is it's, globally it's looking very scary, Prashant. There's no other way I can put it. The statements yesterday from the Bank of England, not just about the pension funds having 3 days to kind of get their act together, but the fact that they're kind of worried about the financial stability in the UK, it's really a telling moment. And I know the market's going to think, okay, at some point, the Fed and central banks will have to, kind of go on hold or, help, ease some of these worries. The problem is this: is if you think about the Bank of England as a company, like with a balance sheet, it's got huge amounts of debt. And its interest costs are rising, and the revenues are coming down because of global slowdown. So, there's only a couple of ways they could really change this. Is that the government would have to rein in spending. But given the recent budget they had, that's going to be a difficult task for them to do so. So you get into this stagflation problem and credibility. And I think that's what's the part that's worrying me is you've seen it with a central bank saying there's problems out there. So what else is hidden under the carpet as we keep tightening? I think will come out from the corporate sector as well. So it's a financial problem I'm looking at now, Prashant. Not the fact that we all probably know that the global economy is going to go into recession in most countries. It's this financial problem which I'm really scared about.
But at the end of the day, in every situation, right, Andrew, good morning. In hindsight, these kind of global turmoils have always worked well for Indian investors. Buying that dip would have helped you make a lot of money. If you look at the last maybe 2, 3, even 10 years, do you think this time around is going to be different? And if not, then should one continue to buy the dip in the Indian market?
No, so you're right. I'm not buying into the kind of narrative that's going around that India's decoupled, but from an overall perspective, our prospects do look a lot brighter. So that I'm not going away from that throughout all of this year. But you can't run away from something which is financially could have an impact on global markets. And it's being played out through the currencies and bond markets at the moment. So at some point it will play through equities. I'm not saying that once that fall happens, it should be the time to get even more constructive on putting more money to work in the Indian market. But just at this point, it's like, it just feels that there's something, the lull before the storm. Something's going to give here in global markets, and we've seen it anyway in terms of virtually all markets are in bear markets now. But I think the earnings revisions yet have to happen, And of course, this unintended consequences, which we're starting to see in the UK, of just tightening. And no one is anywhere near tackling inflation yet. And I think that's what we've got to kind of think about over the next 1 to 2 months. This is a time, I keep saying it's a pivotal time, but I think this is it. This is the moment that we'll be able to see how governments and central banks will have to come together at some point and try to resolve this problem, because it's getting a little bit out of hand, in my view.
So then how does one, look at their portfolio in light of this? What should the asset allocation strategy be between equity, debt, cash, and gold? And at the same time, in equity itself, what are the sectors that you're backing? I mean, if one has to construct a fresh portfolio right now, how would you distribute the money?
So, I mean, I'm not a wealth manager, but I would have thought if you can lock in 7.5 or more, over the next 2 years, which is risk-free, that's obviously a good return to be thinking about. I think with equities, that's where you're going to get the bigger bang for your buck going forward. But I think, I've said before, when the market was falling, that anywhere Nifty around 16,000 is a good entry point to start building. Now, listen, there'll be favourite stocks, favourite sectors within that which can still do well, even in that fall. But I think at this point, you're just really hiding in the kind of safety stocks, which have some pricing power to get relative performance, because our markets cannot withstand a global financial problem.
A few more names which were not in the mix earlier. So HCL Tech is still top of the charts. Varun Beverages is up 1.5%. It sold off yesterday. Aarti Industries is up 3%. So that's another one which is doing well. KRBL is coming up with 2% in gains. Liberty Shoes we pointed out. Marksons we pointed out. Marksons is up 9% now. So almost 51. Panacea Biotech was up 20% yesterday. It's up 1.5%. So slowly starting higher. And there's Aptech, which is up 4% as well. So just a bunch of more names on the upside that we are highlighting. Andrew, so just hiding in defensives, but what really is are defensives really? Because there is the currency risk as well, right?
Yeah, so I'd obviously be more domestic. I'd be looking at telecom and FMCG as the kind of pure kind of domestic safety havens at this point, and they do have some pricing power going forward. So those are the sectors I'd be hiding in if I wanted to get performance. I just think that
the one area from where we've heard company after company sounding pretty pessimistic is the staples space, consumer staples. All right, FMCG pretty much. We had, for example, the Dabur update. We've heard from others as well. So how would you square that? You're saying that the two areas are the FMCG space and which was the other one? Telecom. But FMCG, how would you square the commentary coming in from managements?
Yeah, so I think what we're seeing there, Prashant, is that always you get as input prices start to fall, some of the companies will look to increase market share by reducing prices a little bit more aggressively than others, and then it will stop. But at the end of the day, we're all still going to need to feed ourselves. So that's where the pricing power comes in. As the economy slows. And if you just take again, if you look at what happened in the UK, grocery inflation, if you go to your supermarket, is up 14%. So you will get that pricing power coming back. So it's really a more of a shorter term. We've had a margin hit, and now we're trying to take some market share, and then we'll start increasing prices again, or hold prices where they are, and obviously your costs will not be rising, your input costs will not be rising. And telecom, obviously, with the rollout of 5G, I think will add a lot of momentum for these stocks going forward.
Okay, by the way, the market is picking up pace. A small, a gradual pace, but pace nevertheless. And the space to be in this morning is specialty chemicals. So all your stocks, Aarti Industries, Naveen Fluorine, Deepak Nitrite, are all up anywhere between 2 to 3% So I guess that green shirt worked at the end. I don't know whether it'll last through the course of the day, but we can hope for that, for the sake of the bulls.
Anuj was talking about divine intervention. We got the intervention right here.
Well, if it was only that, if it worked that way every single time, I wouldn't be sitting here, right?
We'll try systematically.
Okay, but
Yeah.
Andrew, what are your thoughts on autos? Because this time around, it's expected to be a pretty strong showing for them. Gross margins are expected to improve. Volumes are going to go up. Supply chain constraints have eased. There's channel filling before the festive season. Do you think the best of the auto stocks performance is yet to come? And if yes, what pockets do you like?
No, I think the auto sector remains a kind of favourite for the longer term. When I say longer term, I mean over the next 1 year, because I think there's too many short term problems out there. And I think the obviously if we're going to a global slowdown, all the input prices for autos will start to come down. And even though you're seeing that in Europe in terms of a downturn, because the order books are so long in terms of people waiting for the cars, whilst it's having an impact on the used car market, people are coming back and buying and putting their orders back for new cars. So I think the prospects for the auto industry remain very good, and I think that the play will be really of who's going to be the winner in the EV market, and that's still a lot to to come through there. So I think some of the best plays would probably be in the auto component segment, which will benefit from anyway the growth in the traditional four-wheeler market as well as EVs going forward. So that's the way I would think about the auto. So you might see some corrections. It's been a good run for some of them, but I think the momentum remains.
Okay, Andrew, we'll leave it at that. Thanks a lot for joining in and have a great one. From autos, let's move to another vessel, shipping. The shipping industry is in focus with rising inflationary pressures across the globe. We've seen a shrinking demand for goods and weakening of cargo movement. Now, this has led to lower freight rates globally. To discuss the impact on the shipping and the container industry, we're joined by G. Shivakumar, who's the Executive Director and CFO of GE Shipping, and Sunil Vaswani, the Executive Director of Container Shipping Lines Association. Gentlemen, morning to both of you, and thanks for joining us on the discussion. Mr. Shivakumar, I want to start with you. What has the exact impact been on the global freight rates because of the challenges that we've seen in pockets like Europe and UK?
Morning, and thanks for having me. The challenges that we're facing in Europe and UK, as you described them, are actually resulting in better rates for the tankers, which is a majority of our fleet. Basically, trade patterns have changed significantly. A lot more Russian crude oil exports are coming to Asia. And those European imports, that is Western European imports, which used to come from Russia, are now coming from East, which is basically the Middle East. And that's resulted in a higher demand for tankers because they just have to go longer distances. And that's why tankers are doing pretty well for the last 6-7 months. Right. So that's the impact we've had from the issues in Europe. On the other hand, you have China, which seems to be slowing down in commodity consumption, which is affecting the dry bulk market. So you have steel production going down, you have iron ore imports going down, you have coal imports going down, which is affecting the large bulk carriers, the Cape sizes, not so much the smaller bulk carriers, which have a lot of other cargoes to carry. But we've seen dry bulk rates come off quite a bit.
Mr. Shivkumar, on the container side, we've been hearing that rates have plunged. I mean, spot rates have plunged, right? And the contract, because bulk of the business, I'm assuming, on the container side is carried out on contract rates, those will follow lower, sharply lower. But for your business on the tanker side or the bulk side, it's the opposite. I mean, things remain as strong as they were the last time you spoke. Is that correct? I mean, even from 3 months, 4 months ago, very strong?
Yeah, on the tanker side, yes, they remain as strong as they were 2-3 months ago. Dry bulk may be marginally weaker on the large size bulk carriers, not so much on the smaller sizes.
And for you, what is the split between dry bulk and tanker oil?
Yeah, so our fleet is 60% crude and product tankers and 10% LPG ships, which are on time charter and don't get affected really by the spot market. The remaining is bulk carriers, dry bulk ships.
And the dry bulk, those rates have come off. Can you tell us by how much, or That's about 30%, 30% of your business, right?
That's right. They've come off, but still at profitable levels. Still at very profitable levels, I'd say. Just the level of profitability is reduced, that's all.
Right, take that point. We do have with us Mr. Sunil K. Vaswani, the Executive Director of Container Shipping Lines Associations as well. Mr. Vaswani, can you give us a sense of what the container availability, the traffic, the demand, etc., is looking for the next couple of months? Because you have the holiday season in the US, you have a lot of, what do you say, a lot of traffic, so to say, that usually takes place in this period of the year. How is it looking as compared to previous years?
Yeah, morning, and first of all, thanks for having me on the show. As you very rightly said, changes have been taking place rather quickly, actually. And as you would have known that during the pandemic, when there was, before the pandemic, there was excess capacity. And during the pandemic, suddenly, there was a surge in demand. And of course, the capacities fell short. So the shipping lines did all they could to get those additional capacities. And as far as India is concerned, we repositioned 1.85 million TEUs of empty containers into the country in 2021. And we introduced additional capacities to the tune of 35,000 TEUs a week, which annualized works out to 1.82 million TEUs annually. Now, these efforts have been continuing this year as well. And as a result of this, the container availability and the space availability is now not an issue. This is freely available. Also, the other thing that's happened is that our ships were actually stuck at ports because of heavy congestion. In January 2022, for instance, we had 14% of our fleet stuck in ports due to congestion, which today has come down to 8%. So that much fleet is additionally available to carry cargo. Although 8% is still not normal, because the normal figure should actually be 2%, but it's still better than that. So that's helped in getting in additional capacities. Number three is, of course, we all know the global economic situation and the situation in the West, which is economically now weak. So that's why the demand also is over there relatively slower. But of course, we are waiting for the sales to begin. That should be anytime now in the next week or two. And then we would know exactly how much is the demand. And also the demand for the spring season, the buyers would start placing orders in November. So once that happens, then we will get to know what the situation is. But one thing is very clear, the freight rates that were there before the pandemic were unrealistic because of excess capacity. The freight rates that were there during the pandemic were also unrealistic because suddenly the demand shot up and we were not prepared for it. But now, after that, what's happening is it's going to be somewhat midway between the two, and the rates should stabilize roughly around those levels. A lot also depends on which way the Russia-Ukraine war goes, because I hope wiser sense prevails and eventually people come to the negotiating table. If that happens, then the surge in the oil prices that are there today, which is actually pulling down the global economy, would stop going to that level, and demand would increase and costs would go down and things would be more stable. So currently that is what I foresee. Thank you.
Got that. Mr. Vaswani, we'll come back to you. Mr. Shivakumar, you made an interesting point where you said that trade patterns have changed quite a bit and now tankers have to move for longer hours. So, and reroute, because of which the demand has gone up. Can you quantify it for us? How much have the rates improved for tankers? How much has the demand gone up by? And how will that reflect in your own business? What could the growth be for you, purely from tankers?
Yeah, so the demand, the impact on our business comes from the change in rates that our ships earn, the day rates, the time charter equivalent day rates. What has happened is that demand hasn't changed very much since before the conflict started in end of February. And now, except for the normal seasonal changes which happen. What has happened is that it's just that the oil travels longer distances, and therefore you need more ships to just perform that work. And I think I mentioned earlier, so ships were across the board, whether they were 45,000 ton product tankers or 150,000 ton crude tankers, were all earning around the $10,000 per day level. today those ships will probably be earning $30,000 a day, and which has been the case for the last 3 months at least. So that's what happens in the rates. And of course, you know that our cost base is more or less fixed. It's just operating expenses, interest, depreciation, overheads. Right. So every additional dollar just goes to the bottom line. So it's just in the change in rates because you just need more tankers worldwide to do the same amount of work because it just has to travel more distances. And there is an upcoming potential disruption, which is the self-embargo by the European Union, which kicks in for crude oil in December and for refined products in February, which could again be a significant disruption of the trade patterns.
Trade environment, Mr. Vaswani, rather Mr. Shivakumar, just a quick one to you once again, Mr. Shivakumar. A lot of the money that shipping companies also make is by buying ships at the bottom end of the cycle and then perhaps selling them at the higher end of the cycle as well. Where in the cycle are we, and what are you doing with regards to buying and selling of fleet?
Yeah, we sold a couple of ships in the last quarter. We sold one of our old gas carriers and one of our older crude tankers in the last quarter. We are now, in fact, now that we've got these strong cash flows and some sale proceeds, we are now net cash. So our cash balance is more than our debt outstanding. So we are waiting for the opportunity. Unfortunately, prices, because, and not just unfortunately, it is logical, that because rates are high, prices of ships are also high. So currently, we don't see an opportunity really to invest in any reasonable quantity. So we'll wait for the opportunity to invest. So shipping companies typically are collecting cash now. Some of them are reinvesting, but we are not.
Okay, all the best. Thanks a lot for joining in. So that is the word coming in on the shipping industry. By the way, for the market, just wanted to point out that it's picking up further pace now. So the Nifty is up about 80 odd points, led by the banks, which are up 140 points. And the advanced decline ratio has also moved swiftly into the green with almost 1,900 stocks. Let's zip into a quick break. On the other side, we'll get you our special segment, Quarter Se Quarter Tak. Today on our radar is the banking sector. To discuss in detail, we'll connect with Vishal Goyal of UBS Securities. Stay tuned.